All right, welcome back to the final round here on Yahoo Finance. Miles Upland with you in New York, and we're joined now by Torsten Sløk. He is the chief international economist at Deutsche Bank. And Torsten, let's begin with the NBER's official declaration today of the U.S. economy in recession. We have talked, obviously, at length, as I'm sure you have with so many of your clients, about the stock market's outlook for the economy. But maybe let's just think about the shape of this recession and how much longer you believe recessionary conditions will prevail in the U.S.
Yeah, Miles, this is in some sense, this is a big day. I mean, because normally a recession is defined as 2 quarters of negative growth. So now that they're coming out saying today, the NBR, who is the official committee who is finding out if we have a recession or not, and they're saying that the recession, also interestingly enough, started in February. They didn't say the recession started in March or in April. So the bottom line is, it's true. The data has, of course, as we know all too well in markets, been very bad now for a while. But this, of course, continues to imply that we are all now looking ahead and figuring out, to your good question, what would the shape of the recovery look like? The fact that we are in a recession and where the employment numbers and the unemployment numbers continue to signal very strongly that we are far behind in terms of getting back to where we were in February. That, of course, also tells you that the Fed this week is probably going to continue to provide more support to the economy. And for markets, it, of course, also means that there's more liquidity, more general stance from the Fed supporting risky assets, supporting credit markets. So the short answer and the short version of this is that, yeah, we are in a recession, but we're standing at the bottom of the canyon now, and we're trying to figure out what will the slope of the recovery be going forward.
So, as you mentioned, the Fed unlikely to really change their tone at all. If anything, they might be more dovish when they come out and speak on Wednesday. But certainly, their meeting on the backdrop of that jobs report, I think will have more people paying attention. When you saw those numbers cross on Friday, and as you've thought about them in the last couple of days, what have you made of that data? And is it as encouraging, I think, as some folks were arguing by the end of Friday?
Yeah, I mean, Miles, you and I have for now almost a decade been discussing the employment report, and here the miss that we had, that the market expected minus 7.5 million, and we got plus 2.5 million. We have never, ever, and we will never, ever get a miss of 10 million jobs in the non-farm payrolls number. I mean, normally, remember, before the virus, we were discussing 150,000, 200,000. We could miss with maybe a maximum 50,000 at the extreme, maybe 75,000, but here we missed by 10 million. So in that sense, you're right, and as you have covered so well here on the show now for the last few days, also it has been a significant issue in terms of misclassification of workers and other things going into, are these numbers really that great? What does it mean that people didn't have a job? Did it mean that they reported that they were staying at home, but they were still associated with the workplace, or were they actually unemployed? But the bottom line is that the 2.5 million that we got did not come from the household survey where you have all these classification discussions. The 2.5 million actually came from the establishment survey, which is where the BLS goes out and the BA goes out and measures how many jobs are actually created in companies. So the economy is certainly now beginning to move in the right direction. We're seeing a lot of the leading, even daily indicators move in the right direction. And that's also why for the Fed going into this week, the main discussion is really that they want to signal that we still have a fairly long road ahead of us.
And, Torsten, I think we talk so often here, as would be expected, about what happens in the U.S. economy, in the U.S. stock market. But I want to ask a bit about how you're seeing the situation in Europe, because they've had just as severe, if not a more severe, outbreak of the virus. And, their economy is very different in a lot of ways in normal times. But the World Bank thinks they'll have a steeper drop in GDP than the U.S. And so certainly there is a dire situation happening there. The ECB has been aggressive. How do you see that situation right now?
Yeah, this is very important. I mean, there's a number of very important differences between what's going on in the US and what's going on in Europe. Most importantly, Europe, and here in particular, of course, Italy, basically had a very severe lockdown. And when you shut down the economy, of course, you're also going to get a much deeper and steeper drop in the economy. So that on its own means that the starting point for the European economy is a lot lower in terms of economic activity. But a very important difference to the upside for Europe is that Europe decided to do what's in German called Kurzarbeit, meaning short working hours, whereby the governments in many European countries, most importantly in Germany, decided to say, we will guarantee all jobs. Just if you don't lay off workers, we will then, if you shorten the working hours, potentially even down to 0 hours a week, we will then pay the salaries of workers to keep them in their jobs. This was very different from in the US, where we allowed a lot of people to get fired. So the bottom line is, where we stand now, is the unemployment rate in Germany has only gone up to roughly around 6%, whereas we know from last Friday the unemployment in the US is now the official number 13.3. So that's why for the US, there's now a much bigger crawl back for the labor market specifically, which is opening up a lot of these investor conversations about, well, doesn't it matter that we need to create all these jobs in the US relative to in many European countries where we had, in particular Germany, people stay in their jobs? They could potentially come back and consume much faster.
Yeah, Torsten, I want to follow up on that because it's interesting what we're seeing happening here in the U.S. as we start to reopen. Europe, as you were just saying, it's been reopening now for a couple of weeks, staying on course. We just heard the news out of New Zealand, the fact that it's basically coronavirus free at this point. But my question to you is, how much weight does the health aspect of this carry compared to earnings and some of the economic data that's out there?
Yeah, that's really important, Gianna, because, I mean, think about this. The shape of the recovery is almost entirely driven by two things, namely, what is the situation with the virus and what is the situation in financial markets? If we believe and if we've seen the virus flatten out and everything is only getting better, that certainly gives more upside risk to the outlook. And likewise, if the situation markets, which is now, of course, a lot better than it was 2 months ago, it continues to improve, that will also provide some upside. But if the virus stops flattening out, and we're seeing across the country in a number of states, of course, we're beginning to see an acceleration in a number of coronavirus cases. It's opening up a lot of discussions about what does that mean? Does it mean we'll have another shutdown? Does it mean that maybe there is a higher risk that people will stop to restaurants to the degree that they're already doing in a number of states where they have reopened? So a lot of those issues, to your good question, really does become very important for when you think about what the shape of the recovery will be looking like. Namely, will we have a longer U ahead of us if there is a second up, even not in the fall, already here over the coming few weeks?
Torsten, arguably China really led the way for recovery after the 2008 recession. Just thinking about which country, which region will be able to really pull through during this global pandemic, during this global recession. Who is your money on right now? Do we anticipate that the US can bounce back to pre-COVID levels and will be the leader on the other side of this?
Yeah, this is of course, a very important question, and it all boils down to social distancing. And this is where this becomes so complicated. In other words, which country do we think is best able to follow social distancing guidelines and follow the rules and requirements that are needed? It's pretty clear that some countries, including China and of course also in Singapore, we have seen much more compliance, much more aggressive implementation of mitigation and containment strategies. Whereas in other countries, including in some countries in Europe, but also here in the US, we've seen more uncertainty about, well, in the open table data that's daily showing how many go to restaurants, it's eye-popping what the restaurant bookings numbers are telling you, that in a number of states in the US, Georgia, Tennessee, Texas, you've seen a basically linear trend in the number of people who are beginning to go out to restaurants again. And that's, of course, opening up this debate about, well, okay, but does that mean that people are just ignoring social distancing? Does it mean that maybe this is only hitting a certain segment of the population? Maybe it's young people going out, and therefore we will begin to flatten out. But it's a really, really important question for global asset allocation, namely, where will we see the social distancing requirements be met, and therefore tracing, testing, and everything else? And where are we likely to see that happen, and therefore the risks being higher of a second wave?